Petrodollar did not die. It mutated, and the moment you understand what it mutated into, you stop getting scared by the headline, and you start reading the scoreboard like the people who actually move money. Because something did happen quietly, and it should have been everywhere. A new data release landed showing global foreign exchange reserves sitting at about $13 trillion, and the dollar still sitting at roughly 56% of allocated reserves. That is not a collapse. That is a system still breathing, still dominant, still paying the bills. At the same time, you see the sentence that keeps getting repeated like a spell. Saudi sells oil to China in yuan. And if you hear that sentence enough times, your brain does what brains do. It compresses the world into a clean story. Oil equals dollars. No more dollars equals no more empire. So you did that. You accepted the clean story because it felt efficient. You saved time. You paid with clarity. Because the real machine was never just about the invoice currency on a barrel of oil. The real machine is about what happens after the invoice clears, where the surplus goes, which asset is trusted, which market is liquid enough to park a mountain of savings without breaking, which currency is the oxygen of global finance when everyone is stressed and everyone needs to refinance, roll debt, and hedge risk at the same time. That is not the word dollars on the invoice. The recycling, the parking lot, the highway system. So let me start with a simple picture you can feel. Imagine the global economy like a city. Oil is not the city. Oil is the water coming into the city. The invoice currency is the label on the water bill. But the petrodollar system is the plumbing, the sewage, the water tower, and the maintenance crew that keeps pressure stable in every neighborhood. You can change the label on some bills and the city still runs on the same pipes until the pipes change. That is the question. Did the pipes change or did the labels change? Now, I am going to promise you something concrete. By the end, you will have a small set of numbers that decide the whole debate. You will not need to argue in comments. You will not need to guess. You will not need to worship a narrative. You will just check the numbers. But before you get that prize, you have to see why the most viral version of this story keeps smart people trapped. Because the viral version sells you a movie. The real version sells you a spreadsheet. And the world is run by the spreadsheet. Here is the first trap. People say the dollar is dominant because oil is priced in dollars. But pricing is only one layer. Settlement is another layer. Reserves are another layer. And liquidity is the layer under all layers. Oil can be priced in dollars and settled in another currency. Oil can be priced in another currency and hedged in dollars. Oil can be swapped in a bilateral deal and still end up recycling into dollar assets because the alternative parking lot is too small or too locked. So when someone tells you petrodollar is dead because a cargo settled in yuan, you do not need to laugh at them. You just need to ask one question. Where did the surplus go after the trade? Because if the surplus still ends up in dollar assets, the system is still running, even if the invoice looks different. Now, let us talk about what actually changed. Because something did change. It did not change in a dramatic overnight collapse. It changed the way a large machine changes when it gets older. It gains extra valves. It gains bypass routes. It gains workarounds. The world watched sanctions, asset freezes, and financial pressure used as tools of policy. And whether you agree with those tools or not, the incentive that follows is the same. If you are a country with large trade flows, you start building a second rail, not because you can replace the first rail tomorrow, because you cannot. You build the second rail because it gives you bargaining power and it gives you an exit in an emergency. That is the mutation. Not a single replacement, a growing set of parallel rails. So when you hear Petroyuan, do not picture the dollar falling off a cliff and the yuan rising like a rocket. Picture a highway system. The dollar is still the biggest highway with the most lanes, the smoothest pavement, the most gas stations, the best lighting, and the most exits to everything you need. The yuan is a newer road being expanded in certain corridors. It is useful, it is growing, but it is not yet the highway the whole planet can rely on during a storm. And you can see that in the boring numbers. The yuan share in global payments by value has been hovering around 3%, often ranked around 6th place among payment currencies in that measurement. 3% is not nothing. 3% is a signal. It says the side road exists and it has traffic. But it also tells you calmly that most traffic is still not there. Now here is the next trap that makes people misunderstand that 3%, they think payment share equals reserve adoption. It does not. Payments are flow. Reserves are stock. Flow can shift faster than stock. Stock shifts only when trust shifts. And trust shifts only when a country can hold the asset, hedge the asset, sell the asset in size, and move money without getting trapped behind controls, rules, or shallow markets. Now we bring in the reserve numbers, because this is where the emotions get separated from reality. Global foreign exchange reserves are around $13 trillion. If the dollar is roughly 56% of allocated reserves, that means something like $7 trillion of reserves are still held in dollars. That is not a rumor. That is a mountain, and the yuan reserve share in that same framework is around 2%. 2% of 13 trillion is roughly a quarter trillion. That is real money. That is not a joke. But it is not the throne, not even close. So you did that. You heard Petroyuan and imagined the dollar collapsing into dust. You saved yourself from thinking through scale. You paid by confusing a new lane with a new highway. Now, let us connect this to your life, because if this is just geopolitics, it is easy to treat it like entertainment. But it is not entertainment. It is your purchasing power. It is your interest rate. It is your mortgage. It is your stock portfolio. Because the petrodollar system is one of the reasons the United States can run persistent deficits without immediate currency crisis. Here is the simple ledger. The United States imports real goods. It exports paper claims, treasuries, agency, debt, corporate bonds, equities, and the world accepts that trade because the dollar system is deep, liquid, and trusted, especially in stress. Now look at the deficit numbers, because this is where the emotion becomes math. The United States ran a federal budget deficit around $1.8 trillion in fiscal year 2024. In fiscal year 2025, it was still around 1.8 trillion, slightly lower, roughly 1.78 trillion. That means the government's spending roughly 7 trillion and bringing in roughly 5.2 trillion, and the gap is being financed. That is not political rhetoric. And the interest expense has become a monster line item. Around $1.2 trillion in annual interest payments has been mentioned as the number in fiscal year 2025 reporting. Now, stop and feel what that means. If you are paying $1.2 trillion a year just to service existing debt, then interest is not a small nuisance. It is one of the biggest expenses. That is your national credit card minimum payment. So you did that. You ignored the boring line called interest. You saved your attention for drama. You paid because the boring line is what drains the room. Now, here is where the petrodollar mutation becomes investable. Because if the world is slowly fragmenting into more settlement rails, even while the dollar remains dominant, the immediate consequence is not a Hollywood collapse. It is friction. More currencies in settlement means more hedging. More hedging means higher transaction costs. Higher transaction costs mean lower margins for some companies and higher margins for others, because someone always sells the shovels. Now, let us name the shovels. If global finance still runs through dollars as the primary highway, then the toll collectors on that highway keep earning big clearing and exchange infrastructure benefits. Think about intercontinental exchange. Think about CME Group. When volatility rises, hedging rises, derivatives, activity rises, banks that do global clearing and trade finance benefit from volume, from spreads, from liquidity premium. Think JP. When the system is stressed, the biggest pipes get used more, not less. Now, if fragmentation increases, you get a second set of winners, the companies that help the physical world reroute flows, energy logistics, midstream shipping. When trade routes get messy, the person who owns the bridge gets paid. So you start looking at names like Kinder Morgan and Williams, not because they are glamorous, but because pipes and contracts matter when politics makes markets less efficient. You did that. You chased the glamorous narrative. You saved yourself from looking at plumbing. You paid because plumbing is where the toll is collected. Now, there is another set of winners that always shows up when trust becomes a debate. Neutral collateral, gold. Not because gold is magic, because gold is nobody else's liability. If a world is fragmenting, Some players increase gold as a hedge against rails they do not fully trust. That does not mean gold replaces the dollar. It means gold becomes a thicker shock absorber. So you look at gold exposure and you see different ways to express it. A miner like Newmont has operating risk. A royalty business like Franco-Nevada or Wheaton Precious Metals has a different profile. Even a broad exposure like a gold ETF becomes part of the conversation when the goal is to hedge tail risk. Now, I am not telling you what to buy. I am telling you what the flows tend to do when the world argues about trust. You did that. You treated hedging as paranoia. You saved yourself from being called dramatic. You paid when volatility arrived and you had no seatbelt. Now, let us get back to the Petroyuan headline, because this is where the comment section will try to drag you into a fake binary. Either the dollar is dead or nothing changed. Both extremes are lazy. The real world is the middle. The dollar is still the main reserve asset, still the main funding currency, still the main safe asset magnet in a crisis. But the world is building alternatives in pockets, and those pockets matter. They matter because they change bargaining power. They matter because they change which country can threaten which country with which tool. They matter because they can reduce reliance at the margins. At the margins is where systems begin to bend before they break. Now, here's the crucial piece most people miss. Even if some oil is settled in yuan, the real question is whether the surplus can be recycled at scale into yuan assets with the same safety and liquidity as US Treasuries. Because when an exporter earns billions, they do not want a heroic story. They want a place to park it. They want to earn yield. They want to be able to sell it tomorrow without crashing the market. They want to be able to hedge it. They want legal clarity. They want a deep market. That is why treasuries are still the world's biggest collateral pool. So the petrodollar mutation is not primarily about Saudi and China. It is about whether there is an alternative collateral ocean big enough to replace the treasury ocean. And right now, the numbers say the ocean is still mostly dollar. So if you want to think like a pro, you stop asking the emotional question, is the petrodollar dead? You start asking the mechanical question. Where is the collateral? Where is the liquidity? Where is the hedging depth? Now, let us make the scales so obvious it becomes impossible to unsee. Global reserves around 13 trillion. Dollar share around 56%. That is roughly 7 trillion in dollar reserves. If that mountain moves, it does not move quietly. It moves in bond yields, FX levels, and funding stress. It changes the price of money. So anyone promising you a sudden collapse has to explain where 7 trillion goes, not where a few oil cargoes settle, where 7 trillion goes. And until you have a believable answer to that, the honest conclusion is not collapse. The honest conclusion is mutation. Now, here is the part where you might be tempted to click away because you want the actionable list. Stay with me, because the actionable list is not a list of tickers. It is a list of dials. And once you have the dials, you can pick tickers that fit your risk tolerance instead of copying someone else's personality. If you've gotten value so far, subscribe, because this channel is going to keep building scoreboards you can use, not just stories you can argue about. And if you know someone who keeps repeating petrodollar is dead like it is a prayer, share this with them. Because the only way to stop being manipulated by headlines is to learn the scale. Now, let's do one more ledger beat, because this is where your personal money connects to this story. You took advantage of cheap imported goods. You saved at the register, but the nation paid through persistent deficits and rising interest expense. And the reason that worked without instant crisis is that the world has been willing to hold dollar assets. If the world fragments faster, the cost of funding can rise. When funding costs rise, valuations compress. That is why this story is not just about oil. It is about discount rates. It is about the price of leverage. It is about whether the next decade is smooth or choppy. And when it is choppy, the market stops rewarding the same things. Now, you are about to see the scoreboard, and the scoreboard is going to make a lot of people angry because it will show that both extremes are wrong. The dollar is not collapsing tomorrow, and the world is not frozen in 1974 forever. The mutation is real, and it shows up in specific places with specific numbers and specific consequences. Now, we are going to put the whole debate into a clean set of dials. You can check every month and every quarter. And then we will map which sectors and companies tend to win in each scenario. whether this stays a slow mutation or whether it accelerates into a true funding shock. So here are the dials. And once you see them, you stop arguing about whether the petrodollar is dead and you start watching whether the machine is tightening or loosening. First dial, reserves, because reserves are the long-term vote of confidence, not the daily noise. Global foreign exchange reserves are roughly in the low teens of trillions of dollars, and the dollar still sits in the mid-50% of allocated reserves. That means the world is still parking something like $7 trillion of official savings in the dollar system. Not because people love America, because when you have to park a mountain, you need a parking lot that does not collapse under the weight. So you watch that, share every quarter, and you do not get hypnotized by a one-quarter move because reserves are slow. They drift. They do not flip like a light switch unless something breaks. And here is the key. Even if the dollar share trends down, you ask where it goes. If it goes into a big, messy bucket of other currencies, that is fragmentation. If it goes into one challenger in a clean, accelerating line, that is a regime shift. Those are two different worlds with two different market behaviors. You did that. You heard dollar share down and assumed it meant dollar finished. You saved yourself from asking where the money actually went. You paid because the destination matters more than the departure. Second dial, payments rails, because payments are flow. And flow is where new roads show up first. You track the yuan share in global payments, not because that number is the truth of the whole system, but because it is a smoke detector. When you see it rising into the low single digits, that is the signal that corridors are being built and used. But you also keep your head, because low single digits is still low single digits. If you want one sanity check that stops the panic in your chest, it is this. A few percent of payment share is meaningful as a trend, but it is not a takeover. And you always compare payments to reserves, because payment usage can expand while reserve adoption remains limited, especially when capital controls and asset depth create friction for large holders. So you did that. You watched a flow number and treated it like a stock number. You saved time. You paid by confusing motion with mass. Third dial, trade invoicing, because trade invoicing is a language businesses choose when they want predictable costs. This is where the petrodollar myth trips people again, because oil is loud, but trade invoicing is the quiet empire. When a company buys components, ships, goods, hedges, currencies, and signs contracts, it tends to choose a currency with deep hedging markets and stable liquidity. So if trade invoicing slowly diversifies, that does not mean the dollar collapses. It means more hedging, more basis risk, more e-friction, and friction shows up in margins. A company with a 10% operating margin cannot absorb an extra 1% of currency friction without feeling it. 1% of revenue does not sound dramatic until you remember that 1% of revenue can be 10% of profit when margins are thin. You did that. You watched the story at the oil well. You saved yourself from looking at the invoice at the factory. You paid because factories, not headlines, decide margins. Fourth dial, the oil leverage dial. Because even if the system is bigger than oil, oil is still the loudest bargaining chip on the table. You watch actual barrels and actual flows. Who is buying, who is selling, and what happens to the price differential when politics heats up. Because you can settle a cargo in any currency you want. But if the buyer demands a discount and the seller needs revenue, the real leverage is still price and flow. When Saudi crude flows to China increase or decrease materially, it is not just a supply story, it is a relationship story. When OPEC adjusts, it changes the revenue stream that gets recycled into assets. When discounts widen, it tells you who has leverage. And here is a simple number logic that makes this tangible. If an exporter earns $100 billion in surplus in a year, where that surplus gets parked is not a philosophical question. It is a market impact question. If even 10% of that surplus changes destination, that is $10 billion shifting demand across asset markets. 10 billion is not the whole world, but it can move prices at the margin, and markets are made at the margin. You did that. You treated oil like a moral story. You saved yourself from treating it like cash flow. You paid because cash flow is what buys influence. Fifth dial, dollar funding. Stress, because this is the part nobody wants to learn until it hurts. The petrodollar system is not only about foreigners holding dollars, it is about the world borrowing in dollars. When global borrowers owe dollars, they need dollars. And when they need dollars, they will sell almost anything to get them in a crisis. So the dollar can strengthen in risk-off periods even while people are telling you the dollar is dying. That is the twist. The dollar can look strongest right when the system is most stressed because it is the currency of debt and collateral. That is why you watch dollar funding stressed indicators. And you do not need to be a bond quant to feel it. You watch whether Treasury auctions are getting sloppy, whether yields spike quickly, whether funding spreads widen, whether the dollar index surges while risk assets fall. Because if the dollar were truly collapsing, you would expect the opposite behavior. You would expect the dollar to weaken persistently even during stress, and you would expect the world to find a new safe asset magnet. That is the hard test. Now, here's where you get your prize, and it is going to make the comment section explode, because it collapses the whole argument into a simple scoreboard. If reserves stay broadly stable in the mid-50s% for the dollar, payments in yuan remain low, single digits, and trade invoicing remains heavily dollar and euro, then the petrodollar is not dead. It is mutating slowly. The world is adding side roads, not replacing the highway. If reserves fall sharply quarter after quarter, payments share climbs and stays elevated, and trade invoicing shifts structurally, then you are not watching a mutation anymore. You are watching a true regime change. And if you are honest, you can admit something that is both true and uncomfortable. Most people yelling about petrodollar death are not tracking any of these dials. They are tracking vibes. You did that. You let the vibe become your portfolio. You saved effort. You paid with whiplash. Now let us map the money, because viewers do not come here just to feel smart. They come here to understand where the cash flows next. In a slow mutation world, the dollar system stays dominant, but fragmentation grows. That means the winners are not only the ones who bet against the dollar, the winners are the ones who sell the tools that a fragmented system needs. Start with exchanges and hedging infrastructure. When hedging demand rises, derivatives volume rises. Volatility is not always bad for the people who collect fees on risk transfer. That is why exchanges like CME Group and Intercontinental Exchange can be structural beneficiaries of more hedging and more uncertainty, even if the market mood is negative. Now, banks, in a world where the dollar remains the main clearing pipe, global banks that dominate clearing and trade finance continue to earn. JP Morgan and Citigroup are simple examples. They are not perfect, they are not pure plays, but they sit on pipes that get used more when money moves more and hedging increases. Now, energy. If the petrodollar is mutating slowly, oil does not stop mattering. It matters through revenue recycling. It matters through capex cycles. It matters through geopolitics. Integrated majors like ExxonMobil and Chevron benefit when global demand is stable and capital discipline holds. If oil prices stay firm and buybacks continue, they can remain cash machines. Oilfield services like Schlumberger and Halliburton tend to benefit when upstream spending is steady. When energy security becomes a policy priority, capex can stay stronger than people expect, even if the economic mood is shaky. Midstream names like Kinder Morgan & Williams benefit when volume and contracts are steady, and when gas and LNG infrastructure keeps expanding to support allies and diversify supply. And here is the part where people get surprised. In a fragmented world, the boring toll roads can outperform the loud ideology because physical flow still has to move. Now, gold in a mutation world, gold tends to act like a hedge for trust debates. Not because it replaces the dollar, but because it is a neutral asset in a world where some quarters want assets that do not depend on another country. SE permission. A miner like Newmont is leveraged to the gold price, but also operational risk. Royalty businesses like Franco-Nevada or Wheaton Precious. Metals tend to have different risk profiles because they are closer to streaming and royalty cash flows than to operating mines. Now, defense, if fragmentation continues, security spending often rises. That tends to support names like Lockheed Martin, RTX, and Northrop Grumman when the world is pricing higher geopolitical risk. You did that? You focused only on the currency headline. You saved yourself from seeing the sector ripple. You paid because the market moves in second-order effects, not just first-order slogans. Now let me talk about the losers, because this is where people quietly bleed money without understanding why. A fragmented settlement world tends to increase transaction friction that hits companies with thin margins, heavy imported input costs, and high leverage. If your business runs on a 3% net margin, and your FX hedging cost rises by 0.5% of revenue, you just lost a chunk of profit. And if your customers will not accept price increases, you eat it. Companies that depend on cheap dollar funding can also get squeezed if spreads widen. When borrowing costs rise, leveraged balance sheets turn from clever to dangerous. And here is the real silent killer. When the cost of capital rises, valuation multiples compress. That is why this story matters to tech, to growth stocks, to anything priced on distant cash flows. You did that. You treated petrodollar as a niche topic. You saved yourself from connecting it to discount rates. You paid when the market repriced everything at once. Now, let us run 3 scenarios, because you cannot position without understanding which world you are in. First scenario, headlines only. This is the world where people keep talking about Petroyuan, but the scoreboard barely changes. Reserves drift slowly. Payments stay low, single digits. Trade invoicing remains anchored in the big currencies. The dollar stays the main safe asset magnet in stress. In that world, you do not need to bet on collapse. You need to avoid being emotionally manipulated into bad timing. You build exposure with diversification, you keep a cash buffer, and you avoid leverage that forces you to sell at the wrong time. Second scenario, mutation accelerates. This is the world where parallel rails expand, not in one dramatic moment, but in many small agreements. More settlement in local currencies, more swap lines, more regional pricing, more hedging activity, more friction. In that world, you often see a persistent risk premium in commodities and in shipping and infrastructure. You see more volatility, you see more rotational leadership, you see the market rewarding hard assets and cash flows more than distant promises. That is where energy infrastructure, commodity hedges, exchanges, and selective defense exposure can behave differently from the broad index. Third scenario, real dollar stress. This is the world people fantasize about, and it is the hardest to achieve because it requires multiple things at once. It requires persistent reserve selling, not just headlines. It requires a fiscal credibility shock, not just a big deficit, because big deficits have existed for years. It requires a credible alternative parking lot large enough to absorb trillions without breaking. And it requires the dollar to lose its safe asset magnet behavior during stress, which is the opposite of what usually happens. If those conditions appear, markets would not whisper. They would scream. You would see persistent weakness in the dollar, persistent stress in Treasury funding, and a reordering of global collateral preferences. Until you see that you do not treat the most extreme outcome as your base case. You treat it as a tail risk. And the way you handle tail risk is not by YOLOing into a narrative. It is by building a portfolio that can survive multiple outcomes. You did that. You wanted one perfect bet. You saved yourself from building a plan. You paid because markets punish people who need one outcome to be right. Now, let me give you something practical you can actually do without pretending you can predict geopolitics. You can separate your exposure into one bucket is core diversified exposure to broad markets because most people are not paid for guessing macro. One bucket is inflation and volatility hedges because fragmentation tends to raise both. One bucket is thematic exposures tied to the pipes and the toll collectors because those can benefit from more hedging and more flow complexity. And one bucket is cash because cash is not a sin. Cash is option. Cash is what lets you buy when the crowd is forced to sell. If you are up big in any theme, you Somi, you do not need to be a hero. You protect part of the win because the internet will never ring a bell at the top. The bell is your discipline. If you are not in yet, you do not chase a narrative spike. You wait for pullbacks, you scale in, and you size positions so you can stay calm. And if you are the kind of person who gets pulled into doom scrolling, you set rules for yourself because the most expensive thing in markets is a nervous system that cannot hold a position. You did that. You let the comment section trade for you. You saved effort. You paid with panic decisions. Now, one more thing, because this is the part that sounds boring, but decides the next decade. The United States deficit is not a headline. It is a permanent pressure. When the federal deficit is around 1.8 trillion a year and interest costs are around 1 trillion a year, you are running a household where the interest on the credit card is one of the biggest bills. That does not mean collapse tomorrow. It means the system needs constant refinancing, constant demand for debt, constant confidence in the collateral. That is why this story never goes away. The petrodollar was one of the reasons the system could absorb deficits for decades. The mutation does not remove that overnight, but it can slowly raise the price of funding if trust and demand shift at the margin. And at the margin is where prices change first. So the next time someone tells you the petrodollar is dead, do not argue. Ask them for the scoreboard. Ask them what happened to reserve shares. Ask them what happened to payments rails. Ask them what happened to trade invoicing. Ask them what happened to dollar funding stress. If they cannot answer, they do not have analysis. They have a mood. If this helped you, like the video, subscribe, and share it with one friend who keeps repeating petrodollar dead without tracking a single dial. And I want you to do one more thing, because it will make this channel smarter and it will make your thinking sharper. Leave a comment with the one dial you think breaks first. Reserves, payments, invoicing, oil flows, or dollar funding stress. Because the comment section will be loud anyway, so we might as well make it useful. Now, take a breath and let the whole picture land. The petrodollar did not die. It mutated. The highway is still the highway, but the side roads are being built. And the people who win the next decade are not the ones who scream the loudest about collapse. They are the ones who quietly track the scoreboard, manage risk, and position for the world that is actually arriving. Not the world that makes for the best tweet,